Has the world of cryptocurrency always been as glittering as it appears today? Cryptocurrency, a digital or virtual form of currency that uses cryptography for security, has seen an astronomical rise in popularity over the last decade. As a new form of wealth, it's attracted investors, technology enthusiasts, and ordinary people alike, all drawn to the promise of high returns and the allure of a financial frontier. But like any frontier, it's not without its dangers. The volatile nature of cryptocurrency markets, the lack of regulation, and the sheer complexity of the technology create a potent mix of risk and reward. This world, as dazzling as it may seem, is fraught with potential pitfalls. From the collapse of major exchanges to high-profile investment scams, the shadowy side of cryptocurrency can be as dark as a moonless night. And so we delve into the lesser-known stories, the ones that don't make the headlines. Behind the scenes of this digital gold rush, there have been some significant bumps in the road. Our journey starts in 2014 with the once dominant Bitcoin exchange Mt. Gox. Born in 2010, Mt. Gox was the brainchild of Jed McCaleb, an American entrepreneur, and it quickly grew to become the world's leading Bitcoin exchange. At its peak, it was handling over 70% of all Bitcoin transactions worldwide. This was no small feat considering the burgeoning interest in cryptocurrencies at the time, but as the saying goes, the higher you climb, the harder you fall. And fall, Mt. Gox did. In February 2014, a crippling blow was dealt to the Bitcoin community when Mt. Gox filed for bankruptcy. The reason? A catastrophic theft of 850,000 Bitcoins, valued at over $450 million at the time. This was not a simple heist. It was a meticulously planned operation that exploited a vulnerability in the Mt. Gox system, allowing the thieves to make off with a staggering amount of digital currency. The aftermath was devastating. Thousands of investors were left in the lurch, their digital wallets emptied overnight. The value of Bitcoin plummeted as confidence in the currency took a nosedive. People questioned the security of cryptocurrencies, and regulators worldwide began to scrutinize the industry with a more critical eye. The Mt. Gox scandal was a stark reminder of the risks inherent in the world of digital currencies. The fallout from the Mt. Gox scandal was far-reaching. It sparked a global conversation about the need for more robust security measures in the crypto world. It led to the introduction of stringent regulations in many countries, and created a climate of caution that continues to shape the crypto landscape today. In the end, the fall of Mt. Gox serves as a sobering lesson. It reminds us that while the world of cryptocurrencies offers immense possibilities, it also comes with its own set of challenges. The promise of decentralization and financial freedom is enticing, but it's a world that requires vigilance, responsibility, and an understanding of the risks involved. The Mt. Gox scandal shook the crypto world to its core, but it was just the beginning. Fast forward to 2017, the year when BitConnect entered the spotlight. BitConnect was initially celebrated as a high-yield investment program, promising sky-high returns to its investors. With a unique multi-level marketing structure, it quickly attracted a large number of people hoping to strike it rich in the crypto gold rush. But was it all it was cracked up to be? BitConnect's operations raised eyebrows right from the start. Critics pointed out that the company's business model bore a striking resemblance to a Ponzi scheme. It relied heavily on new investor funds to pay returns to earlier investors, a classic red flag in the investment world. Yet despite these allegations, BitConnect continued to grow, fueled by the optimism and hype surrounding cryptocurrencies. But the bubble was bound to burst. Regulators from multiple jurisdictions started to take note. The Texas State Securities Board issued a cease and desist order, marking the beginning of the end for BitConnect. The company's assets were frozen and its operations halted. Investors were left high and dry, their dreams of crypto wealth shattered. The BitConnect bust was a cautionary tale, highlighting the potential dangers lurking in the unregulated corners of the cryptocurrency market. It underscored the importance of due diligence and a healthy dose of skepticism when dealing with high-yield investment programs. BitConnect's collapse was a stark reminder of the crypto world's volatility. Now let's dive into the murky waters of crypto investment scams. Just as with traditional markets, the crypto world isn't immune to the machinations of unscrupulous actors. One of the most prevalent scams in this sphere is the pump and dump scheme, where fraudsters inflate the price of a digital coin by spreading false or misleading information. Once the price skyrockets, they sell off their holdings, causing the price to plummet and leaving unsuspecting investors holding worthless coins. Another insidious form of scam is initial coin offering, or ICO, fraud. ICOs are a way for crypto companies to raise funds by selling tokens of a yet-to-be-launched cryptocurrency. Unfortunately, this model has been exploited by scammers who create fake ICOs, collect money from investors, and then disappear without a trace. The case of Centratech serves as a poignant example. The company raised over $25 million in an ICO, only for the founders to be arrested for fraud. These scams can be devastating, not just financially but emotionally as well. The promise of quick profits can blind people to the risks, leading them to invest their hard-earned money in ventures that turn out to be nothing more than smoke and mirrors. The crypto world is an exciting place, full of potential and promise. But it's also a place where caution is required. As the old saying goes, if something seems too good to be true, it probably is. Investment scams have cost innocent people millions, proving that not all that glitters in the crypto world is gold. Lastly, we step into the misty realm of cloud mining scams. Now, cloud mining presents itself as a tantalizing prospect. A chance to mine cryptocurrency without the need for expensive hardware or technical expertise. Sounds too good to be true, right? That's often because it is. Cloud mining companies essentially lease out processing power to users, who then reap the rewards of any mined cryptocurrency. But here's the catch. Scammers have exploited this model, setting up fake cloud mining companies to dupe unsuspecting users. They lure investors with promises of high returns, only to disappear once they've collected enough funds. The infamous crypto cloud is a prime example, vanishing overnight with millions in investor funds. The cloud mining landscape is fraught with peril, riddled with false promises and mirages of easy wealth. In the ever-evolving world of cryptocurrency, it seems that new opportunities often come hand in hand with new risks.